So let's look at the focus of the present. We make two presentations today, and we are going to focus on this essay, this question that you have, which is 3A and B. This is from the second essay, all right? So these questions are a little bit complicated, so we have a couple of presentations to give you the material on which you can, based on which you can answer these questions, okay, because this is not there in your textbook. So let's start with the second one, 3B. So first let's look at this 3B. So if you're looking at if you're doing this question, although the question does not split it up, please split this up into three parts. Right, the first question is this one: what are the main components? So this can be answered in just couple of sentences each, so about six or seven lines. You can answer just the three components of Abenomics. We will look at these components. You will get to know what the names are, and so that's the first part of the answer. Then the second part is basically what were the kind of economic issues or problems that Abenomics was intended as a solution for, tracing the origin of these problems all the way back to a pivotal Japanese asset market event around January 1990. So this is referring to the Japanese asset market event that we are talking about is the Nikkei, the peak in the Nikkei stock average. All right. So let's look at the maximum chart here. Yeah, this one. So that's referring to this asset market event is the peak in the Nikkei stock average, which happens in December 89. Yeah. Oh, sorry. Good point. I totally forgot about that. So I forgot about. Yeah, now it's there. Okay. So now you can see it. So let me just recap quickly, since we I didn't have the projection for a while. So we are trying to, in this presentation, we are trying to give you the material to answer question number 3B, right? First we start with 3B. And so when you see 3B, you should split it up into three parts, although the question doesn't do that. So it is still to be answered as first part, Abenomics. What are the components? So just briefly name the components, and briefly just 2 lines, 1 line or 2 lines is good enough. Then explain the economic issues that Abenomics was a solution for, tracing the origin of these problems all the way back to a pivotal Japanese asset market event. This is 1990. This is referring to the turn in the Japanese stock market. So as you know, the stock market is a leading indicator, so it portends future events in the economy. So this is the Japanese equity market peak in 1989, December 89. So around January 1990 is referring to December 89. So this turn in the Japanese stock market, what happened here, and what were the kind of imbalances that built up, and then once the asset price bubble was pricked, and it started to crash, the kind of problems that manifested themselves. So here we are going to talk about these 20 years of the lost decades of Japan, and then how Abenomics has started to try and make a dent in these kind of problems. And the third one is basically the third part. The second part talks about the economic issues, which led up to the asset market bubble, and then the crash in the asset market, and the continuing problems for 20 years. And then the third part of the answer will provide a critical analysis of Abenomics and its components. That is the three components of Abenomics, by looking at the positive and negative effects of these three components, right? So that's what we are going to look at in this presentation. So let's I'll try to move a little bit quickly because we have a lot of material to cover. And then later on we will cover the question number 3A as well, right? So let me just look at this one first. So we are trying to look at this question number 3B, right? So, and the 3 arrows of Abenomics. So the stock market, as we said, is a leading indicator. So if you remember a couple of lectures back, we had briefly talked about leading, lagging, and coincident indicators. And although that's not in your syllabus, but I gave you the conference board link to look at those different types of indicators. And so the stock market is a leading indicator. You have the Nikkei 225. This is the main index in Japan. It's a peak here in 1989. And then essentially it keeps on going down, or by and large does not recover, as you can see, for almost 20 years. The main decline is in the first decade. This used to be referred to as the lost decade in Japan, as this one was recovering a little bit, but then by the time it comes here, the global financial crisis hits, and then once again Japan gets hit like almost every other country in the world, and then it declines again. So essentially almost 20 years is lost before you get to see a meaningful rally that is able to sustain itself and rise to new highs, right? So that's basically what you see here, talked about. And then from 2013 onwards, you have Abenomics, which drives a rally in the stock market and some kind of economic recovery. And then you have a new high in the stock market. So here's a static chart. So by the way, what I've done is in the presentation, there are static charts that I've inserted into the presentation. But all of the charts that are being used, they have also been shared with you in the spreadsheet file that we have for the module. There is an Abenomics sheet, and there is a dollar-yen sheet, which is the second presentation. So all the chart links are available, so you can use it later on to track these variables on a live basis, because these are the chart links that I've used to actually generate the charts. So these are slide references are also being given here, and the link and the particular variable that is being tracked. So that resource will be there with you. Okay, so here's a chart. We already looked at it. Then let's look at the timeline. So 89 December, by and large, we had a look at this as well. So from 89 to 2003 or so, the stock market goes down almost 80%. Okay, so that's a big drop. Land prices in the big cities will also be falling very sharply in this period. And then deflation begins to set in from about 1998 onwards, and that's why nominal yen GDP basically peaks out for quite some time in 1997, and then makes a new high only in 2016. So nominal yen GDP, which is the basic way to measure your GDP in the local currency, that takes a long time to recover. Yeah, you're looking at residential property prices in Japan, and you can see how there is basically a steady rise, especially from 85, 86 onwards. There's a particularly sharp rise. This is the bubble period, actually. And then after that, and after the 1990 bursting of, you can see how everything in Japan there is every kind of variable that you look at in Japan, or not every kind of variable, but many economic variables in Japan. When you look at them, you'll find that there is a turning point around 1990, which is the peak in the stock market. So here you can see this again. Also, 1990 peak is the residential property prices, and then it comes down all the way and doesn't really start to recover until Abenomics starts to kick in, right? And now you see some kind of recovery. And it came down all the way down to basically levels of 1980. From the levels of, came down all the way to levels of 1980. So that's it. Okay, so now what's the beginning of the problems? What really starts the whole problem going? And that is the Plaza Accord. So what happened was that, if you look at, let's look at some charts of currencies again. Yeah. So these are the currency charts. Now I will explain this to you later in the second presentation, but you have to wait for this chart to load a little bit. So if you want to look at the Plaza Accord, let's go back. Yeah, I think we'll just go back and okay, so now it's loaded, yeah? So this is the dollar-yen chart. This is the dollar-yen exchange rate. So this chart is showing you, I don't know if you can read the stuff, the numbering on the y-axis. So this is going from 360, okay? This is 360, and this is 80 over here. So this is the dollar yen. So this is from 1957 onwards, this data. And so this is showing you the number of yen required to buy one US dollar, all right? This is the way that the dollar yen exchange rate is normally coded in financial markets. Number of yen required to buy one US dollar. So as this chart is going down, it means that the yen is getting stronger and the dollar is getting weaker. And as the chart is going up, it means that the dollar is getting stronger and the yen is getting weaker. Okay, so we'll give you the formula to mechanically derive these conclusions, but this is what you should understand for now. So here you can see the dollar getting progressively weaker from 1971 when the US is taken off the gold standard by Nixon, and then it basically leads to a decline in the value of the US dollar for many years. But in between, in the 1980s, there is a very sharp recovery in the US dollar. It's under US President Reagan, and this goes to the 1985. Therefore, what the US does in 1985, you have the Plaza Accord, which basically the US gets together with a bunch of other countries, and this is called the Plaza Accord because it was from a meeting held at the Plaza Hotel in New York City. So what they decide to do is that the US gets together with other major countries and decides to allow a decline in the value of the dollar because they're very concerned about the high level of the dollar, and they have high deficits and current account and current account deficits and budget deficits. Mainly they're concerned about the trade deficit. So they want it to come down, so they decide to let the dollar decline in value. And so based on that coordinated decision, the dollar declines quite sharply over 85, 86, etc. So as you can see, the dollar falls quite sharply from about 250 yen to basically very quickly it falls to about 160 yen within a year or so. So this sharp decline in the value of the yen, what it does is that so as the dollar declines and the yen becomes stronger, it puts a lot of pressure on Japanese exports, right? You understand that when a currency gets stronger, when a country's currency gets stronger, it becomes harder to export, right? You understand that, right? And when a country's currency gets weaker, it is easier to export because that country's goods become cheaper in the currencies of the importing countries. So therefore, now what's happening is that as Japanese exports are becoming more difficult to sort of sustain because of the strong yen, so Japanese exporters are finding it difficult to compete with other countries. So what the Bank of Japan does is, now here, think about this as well. What happens here? Let me see if I can open this somewhere else. We can actually open it somewhere else, which is okay, let's open this one here and this one here. All right. Here, let me show you something here. Okay, this is. Let's look at this as. Look at the full thing here. Okay. Right. So remember the GDP equation that we studied, right? Like y is equal to c plus i plus g plus x minus m. So try to understand the thinking of the policymakers, because x minus m is exports minus imports. If x comes under pressure, that means that the x minus m ceteris paribus will go down if exports are going down, or at least not increasing. So that means it's becoming harder to increase Japanese GDP, ceteris paribus, if there is pressure on exports. So in order to prop up GDP, what the Japanese policymakers do is they start cutting rates. The Bank of Japan starts cutting interest rates. The idea behind that is that if you cut interest rates, you are likely to stimulate at least, again, coming back to the same equation, helps you to understand a lot of policy moves. If you cut interest rates, it's likely to stimulate investment spending, the I part of it, right? And likely if you have strong consumer spending and a well-developed consumer lending market, then it might even stimulate consumer spending at lower interest rates, right? So lower interest rates are likely to stimulate both investment spending and consumer spending, correct? Okay. So that's the thinking here. But this actually will turn out to be a big mistake. And then, of course, it's not just cutting interest rates. The Japanese government does a lot of things. They take a lot of steps to prop up the economy, and they encourage bank lending against land collateral. They encourage a lot of stock market speculation to basically prop up, economic growth, etc., and general activity levels. So it leads to this kind of Zytec-based corporate speculation. Corporates are earning a lot of their profits from Japanese playing the Japanese stock market. They give them tax incentives as well to do that. So all of this creates a lot of imbalances and creates an asset price bubble. An asset price bubble essentially means that you have a large increase in land prices and as well as a large increase in stock prices. So as you can see here, this is the drop in the value of the dollar following the Plaza Accord. This puts pressure on Japanese exports. The policymakers cut interest rates and take all kinds of other stimulative measures, but that leads to a sharp rise in the asset prices. Okay, so eventually that asset price bubble bursts in 1990. Okay, as the Japanese here, let's go to Nikkei here. As the Japanese central bank starts to tighten interest rates, the asset price bubble bursts and the stock market turns, and as you can see, it declines quite sharply. Okay, in 1 year, it basically wipes out almost 3 years of gains, and so there's a sharp decline in the stock market. Doesn't really recover until this period of 2015-16 levels. That's when it starts to go back up above these levels. So that's the bursting of the bubble. It leads to what is called a balance sheet recession. It's a term that we use. This means that companies and banks are all basically, they have a lot of leverage on their books, there are a lot of debt on their books, and they have a lot of unrealized losses, right? You understand what unrealized losses mean, right? Unrealized losses means that if you buy something at, let's say, $10, you bought something at $10, now that stock is worth only $6, but you have not sold it yet, right? So on paper, we call it a mark-to-market loss. You bought something at $10, now it is worth $6, so you have $4 of losses. But since you have not yet sold it, you have not yet realized the loss. Okay, this is called an unrealized loss. So many firms were stuck because the stock market came down so quickly. Many firms were stuck with these unrealized losses, and what they started to do in terms of a behavioral change, what happened to them was they started focusing on repaying debt. That is deleveraging. It's called deleveraging. That is reducing leverage. They started focusing on repaying debt rather than investing. Okay, so again, what happened was this component of the GDP became quite sluggish. If you look at this, the I part of it became quite sluggish because people were not investing. A lot of companies had unrealized losses on their books, so they didn't really have the capacity or the appetite to invest. So I was quite sluggish, and so the GDP-Y overall was not growing that much, right? And then banks were also stuck with a lot of unrealized losses. They had a lot of bad loans on their books, but again, they didn't really acknowledge those loans. Many of those loans were not acknowledged, and they kept lending to some of their affiliated companies, and these were called like zombie firms. They just kept them afloat with a little bit of lending, and but there wasn't much growth happening. So this kept on going on. This process is continuing, and then you had falling asset prices, of course, which had a negative wealth effect. Now, wealth effect, we haven't studied the wealth effect earlier. Wealth effect means essentially that when stock prices are going up, if you own stocks, let's say when house prices are going up and everyone owns houses, then when house prices are going up, people are feeling rich, right? When house prices are going up and you own the house, maybe you own two, three investment properties, everyone feels rich, right? So therefore, when you feel rich, you go and spend more lavishly. You go to fancy restaurants, you take fancy holidays because you feel rich, right? Your house prices are going up, your stock portfolio is going up in value, so you feel rich. So that stimulates more extravagant spending. Whereas on the other side, you can have the flip side of that. The flip side of that is the negative wealth effect. That is, when asset prices start declining, like this one here, in this period, okay, when it starts to decline, okay, and there's no real recovery, then what happens is that people start to cut down on their spending. They don't feel rich because their stock portfolio is going down, house prices are coming down, so therefore they don't feel rich, and so it works the other way now, right? To reverse negative wealth effect, they cut down on their lavish spending, they spend very little, just minimal spending, and so that's another problem. So that again, what happens again now is that as they cut down, then that starts to hit the C part of it, right? The negative wealth effect is meant to affect, the wealth effect really affects C. It affects consumption spending more than anything else, not so much the I part of it, but consumption spending is affected by the wealth effect. So the C component goes down, again that drags down your GDP, right? Then you have deflation setting in from 1998. So remember what we studied. Deflation is when prices are actually declining, right? It's not like the rate of inflation is coming down, the slowing down of prices are actually declining. So that again, the other problem of that is that the real debt burden starts to rise. So remember what we studied also in the past, that when one of the things we studied in the last session is that when you have inflation, that is bad for lenders, and it's very good for borrowers because they're paying back the loans with cheaper money that is worth less. So on the reverse side, when deflation, we know that inflation is good for borrowers because they're paying back the loans with cheaper money. On the other side, deflation is actually bad for borrowers and it's good for lenders, because when you have deflation, then actually you're paying back the loans with more valuable money because prices are actually declining. So the value of money is going up, and then you're repaying the loans with more valuable money. So therefore, the real debt burden has gone up when it goes up when you have deflation. Some of the numbers here: you have low real GDP growth rate for about a couple of decades. Then you have a sharp rise in the public debt. 60 to 200%, and then you have a very strong yen. You have a very strong yen, that is a weak dollar yen. So what happens here is that if you see from 1990 onwards as well, the dollar keeps on declining, the yen keeps on getting stronger until it here goes to about 76. I'm talking about the dollar yen, and I'm showing you the Nikkei chart here. So you can see the dollar yen actually goes, once it goes down to 80, and again it goes down further. This low is actually lower than this low. So the real low in the dollar yen is after 1971 is this point. Okay, and now of course it's much higher. So it goes down all the way up to here. And so there's a strong yen. That's another factor that is again depressing Japanese exports. And the Nikkei goes down to less than 8,000, which is happening here. We have a live chart of now this is residential property prices. The Nikkei is over here. Here it goes down to less than 8,000 at this point, all right? So you can see basically you got a 20-year decline in the Japanese stock market. Okay, so here you can see, eventually you'll see, so one thing to note is that you see how long the Japanese stock market has declined for, right? So one of the things you'll see happening is that in most countries where there's a well-developed financial planning industry, you'll see a lot of financial planners and investment advisors telling you that in the long run the stock market always goes up. But if you look at Japan, which is like a major country, and in spite of that, it took about 34 years before you saw a new high. So if you invested in the Japanese stock market in 1990, you didn't make money for 34 years, okay, which is a very long time. So next time someone tells you that in the long run the stock market always goes up, just pull out this chart of the Nikkei stock average and show it to them, all right? And tell them what happens if you invest in stocks without a risk management plan, and the stock market does not always go up because you have to sit on losses. You might have to sit on losses for a long time, right? So anyway, so now looking at some of the other things that happen. Here's the important chart here. Please look at this. This is yen GDP, okay, in Japan. So this is the way you normally the first step in measuring GDP, which is the GDP in the local currency, the total value of goods and services produced in a year in the local market for final goods and services, etc. But the point is, this is yen GDP, and then later on you can convert it into dollars and all that. But this is the best measure of GDP because it gives you the true local currency picture of what is happening to economic activity. And as you can see, yen GDP actually does not, it basically starts to decline from about 97 onwards, 96, 97 onwards, and then it goes down and only starts to recover from about 2013 onwards when Abenomics kicks in. The effects of Abenomics kick in. So now, of course, yen GDP has risen a lot, okay, but up until here, we are looking at the problems of this period where it declined a lot, actually. So yen GDP here, and then this is, of course, is dollar GDP. This is again nominal dollar GDP. This one is nominal yen GDP, and this is nominal dollar GDP. All right, so you can see this is here we have a lot more data. Here we have from 94 only, and this one we have from 1960 actually. So we have a lot more data. And of course, dollar GDP, because it requires a conversion of the through the exchange rate, so it is a little distorted by exchange rate movements. So you don't get the true picture. That's why I said you should always look at yen GDP to understand what is happening to economic activity. And the dollar GDP is just required for comparison purposes. This is nominal dollar GDP, about 4 trillion right now for Japan, but it went up to more than 6 trillion. And then it has come down, and partly that is because when you had $6 trillion, that was in 2010 or something. And so if you look at the currency situation in 2010, it was around here, okay? And now the currency is much weaker, okay? So that's why even though nominal GDP is going up, but your real GDP, nominal GDP is in yen is going up, but in dollars is not going up. It's actually going down because the currency is getting weaker. So the same yen amount of GDP is getting converted at a much weaker yen exchange rate. So it's converting into a fewer amount of dollars. So you can see how the dollar nominal GDP number is distorted by yen exchange, by the exchange rate. So that's why you should always look at the local currency GDP to see what's happening in the economy. All right, this is the dollar yen exchange rate. We already looked at it. Okay, so this is billions of chained 2015 yen. Now, whenever you see language like this means it's real GDP, which means that, remember what we had to do to calculate real GDP? We had to use a base year. We used a base year. So base year means this is here, 2015 is the base year, chained to 2015. Okay, chained means that's changed, and that means locked down to reference to 2015. So 2015 base year, this is real GDP in yen. So you can see a more or less steady rise, although basically, you could say that the rate of increase could have been more, etc. Okay, so now what happens in the middle of all these problems? You have Shinzo Abe winning a major election with a strong majority, and then he comes in with a mandate. He wants to end deflation because Japan is stuck in deflation, and so he wants to end it. Now he comes up with the idea of 3 arrows. He didn't call it Abenomics, it's a name given by other people, but he used the idea of the 3 arrows from a Japanese folk tale, so that if you have 3 arrows, then maybe 1 arrow will miss, but the other 2 might hit home. So that's the idea, right? So the idea is to get out of deflation and see some kind of engineer some kind of growth recovery. So Abenomics has 3 components. Okay, this is the first part of your answer, which is arrow 1 is aggressive monetary policy. Arrow 2 will be fiscal consolidation, and arrow 3 will be what is called a growth strategy. So we'll look at those 3 arrows. The first one, so here, aggressive monetary policy. There's a new Bank of Japan governor. 2% inflation target is set up, and they do all kinds of aggressive qualitative and quantitative easing. Quantitative easing we have already studied earlier. Okay, that is what you do when you are trying to, in a very desperate situation, when interest rates are already quite low and still there's no economic recovery, so you try to pump money into the system and reflate the economy by increasing the money supply. So if you remember, the thinking here is exactly like, very similar to the quantity theory of money. Remember, we studied the quantity theory of money, and what did we say? That MV is equal to PY. That means that every time, so if MV is equal to PY, let's look at it here, and then we can see here briefly. Maybe we need to, put this up here. So if we have MV is equal to PY, M into V is equal to P into Y. That's your quantity theory of money. So what did we say? That if M is increased, because V is more or less constant, and Y cannot be affected, that is real output cannot be affected by change in a nominal variable like money supply, because of monetary neutrality and the classical dichotomy. Therefore, the only result of increasing M is an increase in P, right? The price level goes up. So in a way, these guys are trying to basically apply the same kind of theory. The thinking is very similar, that we are going to because they want to actually create inflation. So in order to create inflation, what do? You increase the money supply. And what do? They basically increase the bank reserves component of the money supply by doing massive quantitative easing, right? And they also, by buying huge amounts of, remember what we did, quantitative easing is done through outright open market operations normally, okay? Not through repos, but through outright open market operations. They do quantitative easing, and they pump a lot of bank reserves into the system. That is, the central bank buys bonds outright from the banks. That means if they're buying bonds, that means they're pumping reserves into the system, because if they buy bonds, how would they pay for the bonds? Remember what we looked at? They would credit the reserve accounts of the banks which are held at the central bank, right? So if they credit the reserve accounts of the banks, that means the balances go up, the reserve balances go up. Remember all these things we studied? Okay, so the reserve balances goes up. That is one component of the monetary base, or M0. And so therefore the M0, ceteris paribus, the M0 component of the M0 would go up. Basically, that is one measure of the money supply. So narrow money essentially. And so the idea is that hopefully bank credit is extended aggressively, and people are willing to borrow, and then that would create, that would lead to credit creation, some excess demand, and some inflation. So qualitative easing refers to the kind of securities that were being bought. So they were not just buying government securities, which is the normal thing to do, but they also started buying all kinds of private debt, and they even went into buying equity ETFs, exchange traded funds. So they basically radically expanded the type of assets that were being considered for buying by the central bank. And then you had yield curve control. Yield curve control is, again, trying to control the entire yield curve. So if you remember what we discussed earlier, we had talked about the yield curve here. So I've shown you the yield curve before, right? Remember this? So here, no, we need this here actually to see the thing. So yield curve is simply a plot of interest rates against maturities. So here for US Treasuries. So by yield curve we mean that, so when we say, when they're talking about yield curve control, normally what happens is that the central banks target the, what we call the short end of the yield curve. That is overnight, over here it's overnight, 1 month, 1 week, 2 week, 1 month, etc., that kind of maturity. So usually the central banks try to control the interest rates for short periods of time, that is for short maturities. But then the yield curve extends to many different maturities, so longer and longer maturities. So it goes from zero overnight, 2 weeks, 1 month, 2 months, 3 months, etc., all the way to 5, 10, 20, 30 years, etc. That's called a yield curve, right? Whenever you plot interest rates against maturities, that's called a yield curve. So here, this is the year's Treasury yield curve. You can easily replace this. You can make it, let's say, ICBC bank deposits yield curve by replacing US Treasury, then go to ICBC and find out what interest rate they're paying for different maturities. And if you plot that, that will be a yield curve for ICBC deposit rates. You understand? So yield curve is a general term that you can change by, that you can apply in different contexts by changing the name of the borrower. In this case, the borrower is US Treasuries. But if you change the borrower, as I said, you can have a different kind of yield curve. But the structure will always remain the same. Yields over here and then maturities over here. So what is meant by yield curve control? The Bank of Japan unusually wanted to focus not just on controlling short-term interest rates, but also long-term interest rates. They wanted to control everything, so they started buying securities aggressively across the yield curve, longer dated bonds as well, to try and keep interest rates down across the yield curve. It's a very unusual strategy, completely crazy strategy actually, to be honest. They just went completely bananas on monetary policy in Japan. So this is totally crazy stuff. So anyway, this is what they did. And then they went, of course, to negative interest rates. They started, so if you look at, again, this is a very unusual thing. Not many central banks did it. The US central bank never went to negative rates, but the Japanese bank did. The European Central Bank did as well. The Danish Central Bank also went to negative rates. So some of them went to negative rates, but some of them did not. Negative interest rates, again, essentially the idea is to encourage people to spend money. Because if you keep money and save money and you keep it in the bank, we're going to charge you negative interest rates. So trying to create an incentive for people to spend. That's the first arrow of monetary Abenomics, aggressive monetary policy. The second arrow is fiscal consolidation and flexible fiscal policy, which is sometimes you have in the short run, you try to boost output by through stimulus budgets, stimulus packages. So you had these types of stimulus packages, and then at the same time, because you don't want it to be only one way and increase the deficit, you also want to consolidate the fiscal situation, and so you also introduce some tax hikes, tax increases. As you can see, 2 consumption tax hikes, trying to balance out the fiscal stimulus. That's the second arrow. Third arrow is, you could argue this would be the most important arrow, which is structural reforms, taking care of all the structural problems in the Japanese economy, which are hindering long-term growth. So try to change all those factors. So some of those things which were done, introducing a corporate governance code, stewardship code, etc. So all of these problems, because in Japan you had all kinds of very insidious kind of intercorporate relationships between the banks and and their related subsidiaries, and there are all kinds of very complex relationships, this keiretsu kind of system. So it was not exactly a free market oriented system, so therefore was not perhaps producing that kind of economic vitality. So towards that, they have introduced some of these governance codes and these other codes, trying to improve the structure of overall corporate governance improvements in Japan. And labor market reform, also trying to bring women and older workers into the workforce, because as you know, Japan's population has been declining. Okay, we can look at the working age, total working age adult population. That has been declining. So one of the strategies there is to try and bring more and more people into the workforce, like women and older people, so that at least you have a growing labor force. Then you have trade pacts. Various types of trade pacts that Japan entered into to shore up its exports. So again, all of these you can understand in the context of the GDP equation. And then you have tourism and agricultural reform as well, a little bit of that, to basically, these are all the reform part of it. The third element, structural reforms or growth strategy. The third element, so what are the results? You can see straight away, we already showed you how the yen started to decline from 2013 onwards. Then there is a massive increase in the Nikkei average. And then you have corporate profits, so you can see quickly here. Here, as Abenomics kicks in, there is a large increase in the stock market here. And the currency also around 2013 onwards, you can see it starts the recovery in the value of the dollar. That is, the yen starts to depreciate. So it really starts to weaken against the US dollar, the yen. The yen is weakening against the US dollar here as the US dollar gets stronger. So again, you can see it starts from this 2013 period. So two important turning points in Japan. If you look at the economic variables, a lot of the variables start to turn positive from about 2013 onwards as Abenomics is introduced. And a lot of the variables had started to turn negative from the 1990 period as the stock market peaked, right? So these two important turning points. Then unemployment, I couldn't get a picture of corporate profits. And unemployment has come down to under 3%. And then there's a boom in tourism as well. Here's the unemployment rate. You can see again, once again, you can see that there is a improvement in the unemployment rate from about 2013. As Abenomics is introduced, there's a steady improvement in unemployment. And that's been more or less maintained even after the rise in during the COVID shutdowns. So the arrow one, you can see the positives of arrow one is that the deflationary mindset was finally arrested, and exporters made a lot of money. Stock investors also made a lot of money. And as you can see, the Nikkei finally makes a new high. There's a little bit of inflation that returns, but still very low levels of inflation. So I'm moving a little bit quickly because I'm a little scared that I don't have enough time to cover these two presentations. So I'm moving a little quickly, but since it's recorded, you can play it back and understand it a little better. Right, so here you can see the picture of inflation for Japan, very long-term data here. And as you can see, this is the 1970s, this is the oil embargo when prices went up a lot, and high inflation in Japan because Japan, like the other two big economies in Asia, China and India, Japan is also a net energy oil importer, so they are affected whenever energy prices go up, their import bill will go up, and their inflation, headline inflation will go up as well. Okay, so we got a 5-minute break. We'll see you in 5 minutes. Okay, let's restart here. So where were we? I kind of lost track of where we were, but So we were talking about inflation. I was talking about the energy imports for Japan, and that's why you see the spike in inflation here. But notice one of the things here that is from 1990 onwards, you will see that if you eyeball the chart, you will see that there is a clear change in the level of volatility of inflation. Inflation becomes much less volatile. If you compare it to the earlier period, there's a lot of ups and downs here. From 1990, it becomes much more subdued. And it's only now that you're starting to see the return of volatility and inflation from 2021 onwards. Okay, there is a pickup in inflation, but up until from 1990s all the way through about this period, 2013-15 levels, is quite muted actually. So inflation is still quite low in Japan, but it is starting to pick up. This is Japanese CPI core. The word core is used twice because just to bring it in on par with, make it comparable to core inflation in other countries. So inflation, as we didn't have time to discuss this when we were studying inflation, but inflation is studied at two levels. We have something called headline inflation, which is the main CPI number. And then we also have core inflation, which is the CPI number minus the cost of food and energy. So in most countries, you have a core inflation measure, which strips out the cost of food and energy, and that is called core inflation because food and energy are considered to be very volatile. So we want to see the core inflation picture. And so in Japan, that particular measure is core because what they call core CPI in Japan actually does not split. I think it's the food part that does not, or the energy part that is not stripped out. I'm not sure which one, but if you want to strip out both of them, you need to look at the core number. So that's why we looked at this particular number in Japan. As you can see, there is an increase in the CPI that is starting to kick in from about 2022 onwards, right? So there is increase in inflation in Japan. So finally, they got what they were looking for in Abenomics, in the first arrow especially. That is an increase in inflation. And so here you can see the recovery in the Nikkei average. So it is actually plotting some of those changes here. And then, so what are the negatives of the first arrow? As you can see, they didn't really achieved the 2% inflation target on a sustainable basis. So this need not be a negative actually, because you can actually say that zero inflation should be the goal. Why should you have 2% inflation targets? But since this is the target that they set, you can say that there is a negative here because they couldn't achieve the target on a sustainable basis. Now, the other problem is that the BOJ balance sheet explodes. Okay, they now own about 50% of the JGBs. JGBs stand for Japanese government bonds. Okay, so similarly, Chinese government bonds are called CGBs. So JGBs are called Japanese government bonds. And then the other problem that you had is real wages fell every year between 2013 to 2023. Okay, so although inflation was quite subdued because wage growth was quite stagnant, nominal wage growth, so therefore you had this problem here. Then import prices went up a lot because of the depreciation in the interest in the yen. So as the yen becomes weaker, imports become more expensive. Okay, and exports become easier to generate because it's cheaper for other countries to buy your products. So import prices went up, and then you had, of course, the sharp depreciation in the yen versus the dollar and other currencies as well, right? So this is again, this you can say is probably not a negative. I have just listed it as a negative, but you could always say that it's not really a negative at all, actually. That it's just a thing that happens, your currency moves up and down, and it should not be seen as a negative. Right, here's an interesting chart, the Bank of Japan's total assets. As you can see, whenever the central bank does quantitative easing, what happens? They buy securities, right? They buy securities and they pay for those securities. They buy it through outright open market operations, not through repos, and then generally not through repos. And then what they do is, how do they pay for that? They pay for that by crediting the reserve accounts of the commercial bank at the central bank. And those reserve accounts actually represent the liabilities of the central bank. So the assets are going up, and the liabilities are also going up because they're paying for it by through those by using that technique. So therefore, the total here is showing you the total assets, and of course the liability side has also gone up. So as you can see from 2013, there's an explosion in the size of the Bank of Japan's balance sheet. Now this is definitely not a good thing, right? This is highly abnormal, and no country's central bank's asset size balance sheet should be floating like this. It's a very bad policy. That means that there's a lot of imbalances in the economy. There's too much intervention in the economy. So this is very bad policy straight away, you can see. And the same thing happened in the US as well, actually. So anyway, but this is bad policy. Import prices went up. You can see import prices here. We don't have a lot of data on this, but okay. Then coming to the second arrow, the stimulus packages, the fiscal consolidation. So they managed to prevent, hold up GDP a little bit, and then they also helped to support reconstruction after the Fukushima earthquake. So these are some of the positives. And the negatives of the second arrow, of course, is that you had like the tax hikes. You had a couple of tax hikes, and so whenever you increase taxes, GDP comes down. Well, not really always true, but it puts downward pressure on GDP, right? Remember that when we study taxes, what happens in taxes? In this equation, we don't have taxes here, but remember we talked about leakages and injections when we were looking at the circular flow of income, right? We talked about leakage and injections, and what is the technique that I told you? How do you figure out whether something is a leakage or an injection? The question you have to ask yourself is this component going to increase demand for domestically produced goods and services? If the answer is no, okay, if the question is whether it's going to increase demand for domestically produced goods and services, and if the answer is no, then it's a leakage. If the answer is yes, then it's an injection, right? So in this case, what do you think taxes are? Taxes are injections or leakages? Leakages, very good. Because when you increase taxes, what happens? People have less money to spend on domestically produced goods and services. Taxes are a leakage. So when you do a leakage, then that obviously puts downward pressure on GDP, right? So this is one problem. So they had to do it because of the consolidation element of it. So anyway, so public debt continues to rise, very high debt to GDP ratio, and this of course it is a contradictory arrow, but at least they were trying to stabilize the situation and not going straight away on the deficit spending side. So anyway, so this is Japanese GDP. As you can see, what happened to GDP. This is in US dollar billions. So this is nominal dollar GDP in Japan, right? So you can see that there's not much in, but this is again, because it's dollar GDP, it's not the right focus actually. I just wanted to show you that. But the real focus always has to be local currency GDP, yen GDP, and that too preferably real GDP in yen. Now this is a different kind of chart. This is constant GDP in US dollars. Okay, so whenever you see things like constant GDP means it's real GDP. They are trying to fix it to a base year. Here in this case is 2010. So this is actually per capita real GDP in US dollars per Japan. So it's a complex variable. It has many components to it. So you start with the raw yen GDP, then you have to factor in the exchange rate, you have to factor in the population changes because it's per capita, okay, and you have to also factor in the inflation rate because it is real GDP. So there are actually three elements that are combined into this in addition to the core nominal yen GDP, okay. So anyway, so this is an interesting chart as well. Constant US dollar per capita dollar GDP in Japan. That's basically what this chart is showing you. And you can see a steady creep upwards, right? So Japan still has high per capita GDP, even in dollar terms. Okay. Now here you see the debt to GDP ratio. This is a major number that is looked at for many economies. You have debt to GDP. This is, of course, one of the things you should notice here is that I taught you about stocks and flows. So whenever you see any kind of ratio that we discuss, whether it's in microeconomic or like corporate level analysis or macroeconomic analysis, any kind of ratio that is looked at, you should always think about whether the numerator and the denominator are stocks or flows, whether it's a stock quantity or a flow quantity. That'll help you to refresh that, and it gives you a better perspective on the ratio. So in debt to GDP, is debt a stock quantity or a flow quantity? Flow. Anybody else? Debt. Think about it. Debt. That is the level of debt. What do you see on a balance sheet? Do you see the company's debt on a balance sheet? Can you see that? For most companies, they have debt, right? They have equity and they have debt. So you see it on the balance sheet. So is a balance sheet a stock picture or a flow picture? Stock, right? Because a balance sheet is always as at 31st December. It's always a snapshot at a point of time, right? So therefore debt, since it shows up on the balance sheet side, is a stock quantity. Okay, so debt is always how much debt you have outstanding at a point of time. So debt is a stock quantity, all right? And what about GDP? Is a stock or flow? Flow. Because GDP is always measured over a period of time, right? So when you do debt to GDP, you're actually taking a numerator of a stock and a denominator of a flow, like a flow denominator. So therefore, you could argue that this is perhaps not a good measure, but this is what people look at all the time. So it's a very popular measure, so I just included it. But I want you to think critically about these ratios. Whenever you think about these ratios, you should always look at whether it's a stock to stock or is it stock to flow, and is that a good idea? Perhaps should we make it like a stock to stock figure? Do you understand? So that is stock numerator and stock denominator. Should we have that? So you should you should be asking all these questions. So this is a stock to flow ratio, debt to GDP. Right? So we try to look at basically that there's some value in it in the sense that you're saying, okay, how much money do I owe and how much money do I make every year? So what is my income level every year? And so therefore maybe I can use some of that income to pay down the debt, right? So that's the idea behind this kind of a ratio. But you can see that the number is very, very high for Japan. Okay, so very high numbers, and it's been going up ever since Abenomics was introduced as well. So fiscal consolidation combined with growth strategies, the second and third arrows together, they don't seem to have managed to bring down the debt to GDP ratio, which is very high. Third arrow, what are the positives of the third arrow? So labor force participation, so women in the labor force, that participation ratio went up a lot. Okay, then corporate ROE. ROE stands for return on equity. So it's a very important measure of profitability. So corporate ROE went up a lot. So lots of good news for shareholders in Japanese equities. And then trade agreements, etc. A lot of benefits on the trade side. So third arrow, positives from the structural reform elements. And then you can see here the labor force participation. So one of the success stories of Abenomics is the increase in the labor force participation rate, and especially in the participation rate of women. So traditionally historically Japan has been a very traditional society. Women have not really worked that much. They've tended to be homemakers. But one of the features of Abenomics was to try and bring more women into the workforce, and that has actually succeeded, right? So you could always say that they can do more, but it has succeeded. And as you can see, the labor force participation, once again, look at how from 2013, there is actually around 2013, I'm positioning the cursor around here, and you can see there's a clear increase in the slope of the curve. Can you see that? You see there's an increase in the slope of the chart. from 2013 onwards. So there is a clear improvement. So you can see some, so you can actually see in the data the real effects of policies. So labor force participation rate, I hope you remember the formula from what we studied in unemployment. Labor force participation rate is unemployment. Go check up the formula. It's basically what we studied in unemployment in the second lecture, right? Okay. So that's why we are trying to always refresh our memory on what we studied. Basically the total employed plus unemployed. Okay, labor force so basically this is coming from the labor force as a percentage of the total working age population, right? And the labor force is employed plus unemployed. Okay, so unemployed being you got to be looking for work, otherwise you're not considered to be unemployed. Okay, so that is the idea of the labor force participation rate. Right, arrow 3, negatives of arrow 3, of course, productivity growth still not very good, and dual labor market has not been fixed. So in Japan, you have a problem with the dual labor market, which is part-time labor, right? So there is a very high percentage of people still doing part-time work, and they don't get full benefits and stuff like that. And that is not good for the economy, because what's going to happen if you don't have a full-time job? Do you think you're going to spend very lavishly? You don't have a full-time job? No. You're always insecure because you may not get next week, you may not get work next week. So you're always nervous because you don't have good benefits. So that means that's going to put a dampener on C. Your consumption spending is going to be weak and then that will lead to further, remember we talked about the accelerator effect on investment, okay, through because of increases in GDP. And that will also eventually have some kind of negative impact on investment if consumption spending is weak, because C will also drive I eventually through a lag. So all these things will have a negative impact. So this is not a good thing. They have to fix it. They have not been able to do it. Agricultural protection is still intact, but for this you can't really blame Japan, because almost every country has highly protected agricultural markets. But then still Japan could have moved ahead on its own, but they haven't been able to do that. So this is not a very successful arrow. Arrow 3, structural reform has not succeeded at all, really. Well, not at all, but shouldn't say at all, but really not delivered up to expectations. The productivity in Japan, quite low, as you can see the productivity chart here, not really improving. And here then you see another very bad chart for productivity in Japan. So when you're studying productivity, you should remember, okay, just like labor force, we looked at the formula for the participation rate. We tried to remember the formula. Then remember we studied the Solo-Swan production function, and we tried to look at the labor productivity equation. Y by L. Y by L is equal to K, is a function of K by L, H by L, remember? Human capital, natural resources per worker, etc. Right? So this is the labor productivity picture in Japan. Of course, many other countries as well. And you can see that pretty much almost every country is doing badly, and Japan in particular is doing quite badly, right? So even the US, which is considered the most dynamic economy, is not doing particularly well with labor productivity. So now here's the part-time employment chart that I told you about. So part-time employment, again, quite shooting up. But what we really need is part-time employment as a fraction of total employment, but I couldn't get that data. So total part-time employment still going up. Overall verdict on Abenomics, 2 of the arrows did their job, the third one did not. So some of these elements here you can put in. Per capita GDP growth rate is still quite low, but at least you could say at least it's growing. Some success was achieved, and not having a self-sustaining wage price spiral. Some of these could also be benefits, because you really don't want to have too much inflation. You don't want a wage price spiral really. So this is some of the elements. So the stock market is a clear winner, because after Abenomics was introduced, the performance on the stock equity side is very good. So that's a clear winner actually. Then per capita GDP here, this is what is this? This is US dollar per capita GDP for Japan. Okay, so this is a chart that we looked at earlier as well. So I'm just repeating that chart here. Per capita, why are we looking at per capita GDP in dollar terms? Because it makes it comparable to other countries. So one of the things you can see, and why do we look at per capita GDP? Because we use it as a measure of wealth, right? Not just a measure of well-being, that is GDP. But per capita GDP, when we ask a question of how wealthy is a country, we tend to look at the per capita GDP number. Okay, so that's, now you can argue whether that's a good measure or not, but that's what we normally look at. So this is why we are looking at per capita GDP. So if you look at wealth, Japanese, the level of prosperity is still more or less being maintained. So that's a positive sign, I guess. It could be a lot worse. And some of these other elements of what happened in Abenomics. Yeah, so not really not being able to restore dynamism. Let's see what happens in the future. Okay, so more recent developments in Japan. The negative rates were ended by the Bank of Japan in March 2024. So they're coming out of the problems of the first arrow of aggressive monetary policy. Some of the excesses of that particular arrow, negative rates were ended. Yield curve control was also ended. The yen has moved to depreciated quite a lot, as you can see. Very, much weaker levels of yen than you have seen in the last several years. And then here you have, wage growth starting to come up, right? So some of the benefits. Now this is the new, this is the new policy target rate of the Bank of Japan, which is the overnight call money interbank rate, which is, we don't have full data here. We do have the data from up to about October 2025, so we do have data here. So as you can see that it starts declining from 1990 onwards at the time of the stock market peak. Interest rates are being cut by the Bank of Japan to stimulate the economy. And then they remain low for so many years, for almost 20 years actually. 25 years they remain, and they're just starting to rise. And this is the Bank of Japan interest rate. This is the discount rate. And the discount rate is going to closely track the new policy target, which is the overnight call money rate. Right? So that's the end of your presentation for this one. So this will help you to answer the second part of question number 3. In the second essay is basically 3 and 4, and so you answer either 3 or 4. Okay, so let's move on quickly. So I'm going to stop the presentation now. I'm going to stop the recording now. I'm going to keep these as discrete presentations.